Nearly half of all workers in the U.S. have no retirement savings set aside, and over one-fifth have less than $5,000 saved. Hello, my name is Nikki Young, and I'm an enrolled agent with Latino Tax Pro. We're an association dedicated to serving the needs of the Latino community through tax preparation training in both English and Spanish. Nearly half of all workers in the U.S. have no retirement savings set aside, and over one-fifth have less than $5,000 saved. Today, we're going to look at the highlights of the different new acts going in to see what kind of a difference that can make on people's retirement. We're going to look at the Secure Act and look at the details on the available tax credits and other important provisions of the act. We're going to look at the CARES Act and the relief for administrators and participants of any plan, and key differences between retirement plans and how you can help your clients save for retirement. So the current retirement landscape, the Secure Act becomes a game changer for the retirement industry. Significant increase in tax incentives for employers starting a plan. There are new safe harbor guidelines and new types of plans such as pooled employer plan, PEP. I don't think they meant it that way, or maybe they did. COVID-19 effect on businesses and employees. The CARES Act addressed the situation by providing relief to employers and plan participants by easing some of the tax rules and penalties applicable to retirement plans. State mandated retirement plans. Several states enacted mandates on certain businesses to make available a retirement plan for their employees or face penalties for non-compliance. 8 states have an active plan. 3 of those states, Oregon, California, Illinois, made it mandatory. The other 5 are voluntary or marketplaces established. 4 states have a timeline. Maryland, sometime in 2021. New Jersey, by March of 21. Connecticut, got to wait till January of 2023. And Colorado, late 2021. So let's look at the Secure Act. This legislation passed the House very decisively in July and then was part of a broader spending package that was signed into law in December of 2019. Now, we've heard about this before, but we're looking at it in more detail now because we're going to have clients coming in for tax year 2020 during this year's tax season. This was created to address a growing savings crisis in America. And that is, nearly half of all workers in the U.S. have no retirement savings set aside, and over one-fifth have less than $5,000 saved. This is putting most Americans on a long-term path towards delayed retirement, if that will be an option at all for many. The U.S. government is making it easier for businesses to establish retirement plans for their employees and finally addressing some needed enhancements to out-of-date rules that have been in place for decades. I've often told my clients that the best thing they can do to plan for retirement is now, when they're young, to buy a house and then to get into some type of a savings plan, retirement savings plan, because you don't want to have to depend on work when you reach retirement age, because that can be very scary. Well, the first and most exciting provision that we will cover is the increased tax credit that is available to employers. The credit's allowed to be claimed to offset half of the employer's eligible retirement plan costs for administration and educating participants each year for the first 3 years that the plan was in effect. In prior years, this was limited to a maximum credit of $500 each year for a total of $1,500. But beginning in 2020, an employer can claim a credit up to $5,000 towards those expenses. Eligible retirement plan costs include setting up and administering the plan. This would include a provider's setup or installation fee and the billable admin fees that may be assessed monthly, quarterly, or annually, depending on the provider. And this could include third-party administrator costs as well. It can also apply to costs associated with educating employees about the plan. There's also an additional tax credit that is now offered to employers that was not available in the past. If an employer establishes a plan with automatic enrollment or amends a current retirement plan to offer this feature, they may claim this $500 tax credit for the first 3 years. This is in addition to the startup tax credit, meaning an employer could claim up to $5,500 each year for 3 years. Now, with the average lifespan of Americans increasing, it was time for the required minimum distribution age to increase. So a time before you have to take money out. The Secure Act raises the required minimum distribution age from 70 and a half to 72. I'll take it. Now that's beginning January 1st, 2020. For individuals that reached 70 and a half prior to December 31, 2019, they will be required to begin or continue RMDs. Now let's transition to a brief overview regarding different options for your clients planned during COVID-19 and how the CARES Act provides relief to participants. So to qualify for the CARES Act loan and distribution relief, the request must be related to COVID, and it must be self-certified by the participant and confirmed by the plan administrator. So a participant actively employed or on a leave of absence will qualify if any of the following conditions are met. He or she, a spouse or dependent, was diagnosed with COVID-19. So obviously you need to be able to back up what you're doing with documentation from medical staff. He or she has experienced adverse financial consequences because of quarantine, furlough, layoff, reduced work hours, or lack of childcare due to COVID-19. The business was closed or had reduced operating hours due to COVID-19. And boy, we know that's been a lot. So what about relief for participants? So on June 19th, the IRS expanded the definition of who is considered a qualifying individual for requesting a COVID-19 related distribution or loan. So reductions in pay, rescissions of job offers and delayed start dates, and adverse financial consequences from the impact of COVID-19 on their spouse or other household members. Back it up with document. So accordingly, a qualifying individual is anyone who is diagnosed or whose spouse or dependent is diagnosed with the virus or experiences adverse financial consequences as a result of an individual, the individual spouse, or some member of the household that is someone who shares the individual's principal residence. They're in the household. So being quarantined, being furloughed or laid off, or having work hours reduced, being unable to work due to lack of child care due to COVID-19, closing or reducing hours of a business that they own or operate due to COVID-19, having pay or self-employment income reduced due to COVID, and having a job offer rescinded or start date for a job delayed due to COVID. Now, new loans. You could have borrowed some money out of your 401k between March 27th and September 23rd of 2020. Hopefully, you had that opportunity. Qualifying participants were permitted to take a loan from their retirement plan, of course, if the plan allowed for loans. The maximum loan amount for loans was increased to the less of 100% of a participant's vested account balance, or $100,000, minus any outstanding loan balances. And loans is a good way to go because you pay it back, you're basically paying yourself back plus interest. Now, participants who have a new loan balance between March 27th and December 31st, 2020 can defer repayments for up to 1 year. However, loan payments are required to start again on January 1, 2021. If you qualifying participants who held a retirement plan loan balances between March 27th and December 31st of 2020 can defer existing loan repayments for up to 1 year. The loan balances will continue to accrue interest during this delayed time frame, but again, it's just interest to yourself. And the maximum 5-year loan term is disregarded for outstanding loans deferring payment for 1 year. Also, qualifying participants can take a distribution of up to $100,000 between January 1st and December 31st, 2020 from a qualified retirement plan. So yeah, it's too late for you to take some money out, but if your client comes in and had taken out, then you need to know this. The CARES Act waives the 10% early withdrawal penalty for anyone under the age of 59 and a half. And the 10% federal tax will be withheld. That's the thing I always advise my clients when considering taking money out. It says, okay, you won't pay that 10% early withdrawal penalty, but it is still taxable income that you pay federal and state tax on. Also, the distribution is not eligible for a rollover, and participants may recontribute the amount within 3 years of the distribution to any 401k, 403b, or 457b plans, or an IRA that allows for rollover contributions. However, repayment is not required. But again, you take it out, that's saved for retirement. I would certainly do what I can to reinvest and put money back in there. Now, if a state is declared a federal disaster area by the Federal Emergency Management Agency, FEMA, plan participants residing or employed in those states may be eligible for a 401k hardship withdrawal for expenses and losses incurred because of the disaster. The plan must be all for hardship withdrawals to count. And FEMA is updating the state list regularly, so please verify if your state qualifies online at fema.gov/disasters. Require minimum distributions. They are suspended for 2020. So if you're over the age of 7.5 and you have to take it, you didn't for 2020. And that's for all qualifying RMD retirement plans and IRA participants required to withdraw funds from such retirement accounts between January 1st and December 31st of 2020. This includes required beginning date distributions for April 1st, 2020. All right, let's dive now into the details of 401k plans and review some of the advantages to business owners and to you and me as employees. So first of all, here are some common misconceptions about 401k plans that we hear from business owners. Retirement plans are too expensive. Well, the Secure Act addresses this with the increased tax credits. It's a potential for up to $16,500 over 3 years. And again, that depending on eligibility and adding auto enrollment. My company's too small to offer a retirement plan. Well, plans such as 401ks exist for all business sizes, including sole proprietorships with no employees. Tax credits exist to encourage small businesses to start a plan. My employees can't afford it. Actually, the impact on employees' net pay is less than expected with pre-tax deductions, and that's what I stress to my clients. If they have any 401k, you usually see a small amount, and I'll dare them to double it, triple it, maybe even quadruple it from what they have withholding now, and then tell them, put that in, greatly increase the amount, and then check one paycheck and the next paycheck after it starts, and compare your take-home pay. Because of its reduction and reducing of taxable income, most of my clients who do increase it are very surprised how little it changed their take-home pay, but great for when they need to have money when they retire. A simple IRA is enough. Well, yes, but you can't put as much into those types of plans as you can 401ks. Also, it's too complicated. Many affordable solutions exist to ease the administration of retirement plans. So it's worth it even if it's maybe a little confusing at first. So why consider a 401k plan? 3 great reasons why companies should consider adopting 401k plan. Nearly any growing business will want to have ways to put more revenue back into their business, plan for the future, and employ a strong workforce. And that's a good incentive. Individual and business tax savings. It helps employees and owners save for tomorrow. And when I say tomorrow, I don't mean tomorrow, I mean when you get old and really can't work, now you've got money to fall back on. And it also helps to attract and retain quality employees. So this example shows a 50-year-old making $150,000 annually and the amount that they could contribute. The chart's a comparison of the contribution limits of the most popular retirement plans. As you can see, a 401k plan gives you the highest potential to defer monies based on the IRS limits. Doesn't mean you have to put that much, but you are able to put as much as possible. So as you can see there, even from an employer standpoint, the savings can be up to $63,500 in a year for your company and for yourself versus the smaller amounts for the other types of retirement and savings plans that are out there. The lowest, of course, is a traditional IRA. Now, if that's all you got, keep putting it in there, but that certainly isn't a whole lot per depending on the different plans. So your 401k highlights automated contributions, pre-tax, or it could be post-tax. Some people like the idea of Roth, but personally, I found for myself the traditional IRAs and 401k plans work best. Contribute more than an IRA. Change contribution level anytime. That's a good one. Multiple plan types, different vesting schedules, rollovers, loans, and managed account options offer added flexibility, and profit sharing is allowed. What are the benefits? Tax deferred growth. And people say, well, later on I'll have to pay tax. Well, later on you're not going to be making as much. Once you are retired, your income drops usually. Well, my experience with my clients is it drops a lot. They've got money savings, invested, and homes that are paid off, all these things to make them secure for the future. But when you had the tax deferred growth, when you had the tax benefits is when you were young and your family needed it. Also, you can do higher contribution limits, reduces taxable income. Many of the plan expenses are tax deductible, and the Secure Act tax credits, significant increase on tax credits for employers to offset startup costs and tax credit for implementing automatic enrollment. So, key takeaways, you're in a unique position to explain the advantages of offering a retirement plan and highlighting effective tax strategies, as well as explaining the new legislation in the Secures and CARES Acts and the state mandates. The Secures Act makes it more plausible for businesses of all sizes to start a retirement plan. And it's important to review the best plans and features for your clients' needs. So thank you for your attendance and attention. We hope you found this presentation beneficial. If you want to see more topics in the future, be sure to like and subscribe. We'd love to have you visit our website at latinotaxpro.org or call us at the number 866-936-2587. Until next time.